Hi, Mr. Mortgage back at you. It's Monday. Today we're going to talk about Wells Fargo Bank and all the toxic waste they have on their books. But before I do, I want to comment on WAMU. WAMU is up on rumors or leaks, SEC, where are you, that they're getting $5 billion, which really is a pea hole in a snowbank compared to how many subprime loans, home equity lines of credit, and the abortion of a loan program pay option arms they have on their books. I don't find it any coincidence that Countrywide, IndyMac, Downey, First Fed, Bank United, WAMU, Wachovia, Lehman, and Bear, their stock prices are all doing that. They were the most highly exposed to pay option arms. Those loans have been unsaleable for quite some time. People ask me why I focus on what kind of loans people had on their books they used to do. That's because the loans these people used to do are the ones they got caught with when the market fell apart and they couldn't sell them any longer. Got caught with billions and billions of these. People think the market stopped, the secondary market shut down in August of 2007 when Kramer finally came out and ranted on TV. You remember a month before that he was saying, Downey savings 100 on his knuckles. But in reality, it started getting real weak in the latter part of 2006 when Bill Dallas put down Own It, O-W-N-I-T, Bill Dallas. You can look it up on the internet. He had the money to pay cash for the margin call that Merrill gave him. I think it was $50 million. He decided not to. He gave a speech shortly thereafter saying the mortgage industry as we know it is dead. There will be no wholesale or correspondent or secondary market within a year. Sure enough, it came true. He was the father of the wholesale and correspondent mortgage industry pretty much back when it was, you know, a really solid, good business. He started First Franklin several years ago. Quality, upstanding guy. Nevertheless, what happened is, the reason why I focus on what they have on their books is because the industry started losing its bid, you know, at the end of 06 or 07. But the lenders kept on churning out loans, more and more and more loans, trying to pump up volume, lowering rates, easing guidelines, even into 2007. They couldn't sell the loans, and they kept them on the shelf, knowing the market would come back, because it always has before in the past. Finally, when they realized it didn't come back, they had to shut everything down mid-year to late year 2007, and they're stuck with all those. You know, a year's worth of production in some cases. So it's real important to know what kind of loan each lender did, the subtle differences between their lending styles, and which ones they might have the most on their books. So, we're going to do Wells Fargo right now. But before we do, I want you to say hello to my little friend. Easy Al is for sale, $15,000. No third mortgages, no negative equity warrants, nothing with acronyms. Only cash. USD is an acronym, but that's okay. So, we're going to get into Wells Fargo Bank now and see what they did. They've been saying they're squeaky clean, even though they have $84 billion in home equity lines of credit that can't be sold for any amount of money right now, that are just waiting to default, that they can't foreclose on. As a matter of fact, I did a YouTube broadcast, if you check out my channel, on second mortgages, home equity line exposure by the banks. Go check it out. It's real informative, or so I'm told. Okay, Wells Fargo Bank. Da-da-da. Wells Fargo correspondent alternative lending traditional non-prime rate sheet. This is Wells Fargo's subprime wholesale rate sheet. Now if you look here, 12-month housing history, 0 times 30-day late, that's good, down to 500 credit score. Oh, 1 times 30, down to 500 credit score. Oh, 2 times 30, down to 500 credit score. Oops, 1 times 60, 1 times 90, still down to 500 credit score. 1 times 120, they weren't even foreclosing and doing down to 500 credit score. And if you take a look, they went all the way over to 100% loans. They did 228s, and they did 30-year fixed, and there's those famous 3-year prepays everyone's talking about. Their rates were rather aggressive too. 1 times 30, you're getting the 7%, all the way up to a 100% loan. Actually, a little 8% there at 100%, but still. That's what a 30-year jumbo is now. On an A-paper borrower with 720 credit scores and 20% down. Wells Fargo was doing those kind of loans. So, whenever you hear Wells Fargo didn't do it, there's your proof. Wells Fargo did it. They're not telling you the truth. Another loan program they specialized in and did even more than the home equity lines of credit or the subprime loans was their hybrid intermediate term arms. Wells Fargo led the market for years, since 03 on these. They're fixed for 3, 5, 7, or 10 years. And then they turn into a 1-year arm after that. They qualify typically the interest-only payment. They allow up to 50 debt-to-income ratios, meaning if you make 10 grand a month, $5,000 of that can go out to debt on your credit report, leaving you $5,000 to pay your taxes, pay your food, pay your gas, pay your insurance, save money. You know, it just doesn't work. You're putting the borrowers in the grave if the home doesn't appreciate. Of course, you know, we pretty much lost all of our appreciation from 2005 now with the massive drops in the bubble states in which Wells Fargo lent the most money. Wells Fargo would go 80% to $1 million, allow a 95% combined loan to value, do the first and the second mortgage. Again, 50 ratios down to 620 credit scores on this program. This is not what I consider prime. The ratings agencies just haven't got there yet. The hybrid intermediate term arms, actually the same kind of programs Thornburg has on their sheets, but Thornburg actually did ask for much larger reserves. 6 months, Wells Fargo would ask for 2 months, or no reserves in so far as stated asset programs. There are hits, there are adjustments to rates if you wanted to do cash out or verification of assets, stated income, or condos or loans to $1 million, or the riskier type programs were very light, as you can see here. Here's a rate sheet from 2/10 of 05, right? There are the programs, non-conforming, and this is jumbo money, by the way, up to $1 million, 3-1, 5-1, 7-1, 10-1. These are their adjusters, as you can see. For example, 620 credit score, fixed rate or ARM, all the way to 80. There's only a quarter point there, 3/4 there. You know, their hits are very light for what they do. $1 million loan, right here, fixed rate and ARM, no hits. Remember, 3/4 in fee is only a quarter in rate. That, you know, they would just raise the rate on the borrower to compensate for the adjustments. But the rates were still very, very low. So anyway, we have in black and white, Wells Fargo did subprime. They've told us they have $84 billion worth of home equity lines of credit or home equity loans on their books, of which they say they're going to sell $12 billion of it for 88 cents on the dollar, which just doesn't exist. And now we know how they qualified and what they consider to be prime in their hybrid intermediate term arms, which I don't consider prime, and I think the ratings agencies will catch up to them pretty soon. So you make that decision. Has Wells Fargo been honest with you about the kinds of loans they did in the past? Have they been honest with you about their exposure? That's for you to decide and me to report. Have a great day, and we'll talk to you soon. And if you like this video, please go and give me a good rating there. The ones you've given me on the others were very nice. Thank you very much, and I appreciate it. Have a good day. Bye-bye.